Let me be completely honest with you about something that most people in this space are not going to tell you. I have been investing for 35 years. I have made millions of dollars. And the strategy that got me there was embarrassingly simple. I did not pick individual stocks. I did not hire a fund manager. I did not follow hot tips or watch trading charts at 2 in the morning. I put my money into an S&P 500 index fund, left it alone, watched it compound at over 10% annually. That is it. That is the whole secret. And for 3.5 decades, it worked beautifully. But something happened recently that made me sit down, pull up my entire portfolio, and start making changes for the first time in years. Not because the strategy broke, not because I panicked, but because I looked at what is actually sitting inside that index fund right now, what it is really betting on, and I realized that the thing I thought was protecting me through diversification might actually be concentrating my risk in one of the most speculative technological bets in modern financial history. And that bet has a name. It is called artificial intelligence. So in this video, I'm going to walk you through exactly what I found, exactly what I changed, and exactly why. Not to scare you, not to tell you the market is about to crash, but because after 35 years of building real wealth, I believe the people who understand what is happening right now and position themselves accordingly are the ones who are going to look back in 20 years and feel very, very smart. And the people who do not are going to wonder what went wrong. Let us start with the basics, because I want to make sure we are all on the same page before we get into the stuff that actually matters. An S&P 500 index fund is what is known as passive investing. Instead of trying to pick winning stocks, you buy a small piece of all 500 of the largest companies in America at once. The idea is simple and brilliant. Even if some companies fail, you are protected because you own so many of them. And as the overall market grows, so does your investment. No guessing, no gambling, no expertise required. You just buy, hold, and let time do the work. Now here's where it gets interesting, and here's the thing that most people who invest in these funds do not fully understand. The S&P 500 is what is called market cap weighted. What that means in plain English is that the bigger a company becomes, the more of your money automatically flows into it. It is not a democracy where every company gets an equal slice. It is a popularity contest, and the most popular companies get the most votes. So here is the question I started asking myself. Where exactly is my money going right now? I pulled the numbers, and what I found stopped me cold. For every single dollar you put into an S&P 500 index fund today, 40 cents of it goes to just 10 companies. 10 companies out of 500. That is 40% of your entire investment concentrated in a tiny group at the top. And those 10 companies are NVIDIA, Microsoft, Apple, Alphabet, Amazon, Broadcom, Meta, Tesla, Berkshire Hathaway, and JP Morgan. Now, 40% in 10 stocks is already a significant concentration. But the number that really caught my attention was this. NVIDIA alone is capturing somewhere between 7 and 8 cents of every dollar you invest. One company, 7 to 8%. And the reason NVIDIA has grown to occupy such an enormous slice of the index is because its stock price has gone absolutely parabolic, which means through the mechanics of market cap weighting, the index automatically funnels more and more of your passive investment money into it every single time the stock rises. If we set aside Berkshire Hathaway and JP Morgan for a moment, something very revealing starts to emerge from that list. What you're left with is a collection of companies that share one defining characteristic. Every single one of them is spending aggressively, massively, and in some cases recklessly on artificial intelligence. NVIDIA is building the chips that power AI. Microsoft, Alphabet, Amazon, and Meta are racing to deploy AI. Apple is integrating it into every device. These companies are not just dabbling in AI. They have made it the central thesis of their entire valuation. And at face value, you might say that is exciting. AI is the future. Of course these companies are going up. Of course they are worth more. And maybe that is true. But here's the part that should give every rational investor pause. For all of the AI companies at the top of the S&P 500 to justify their current valuations, the AI industry needs to generate roughly $2 trillion in revenue. $2 trillion. Let me put that into a context that actually means something. That number is more than NVIDIA, Microsoft, Apple, Alphabet, Amazon, and Meta generated combined in 2024. All of them, together in an entire year. What this tells you is that these companies are not being priced on what they earn today. They are being priced on what someone hopes they will earn in some imagined future, which, again, is not necessarily a disaster. Growth investing has always involved buying into potential. But there is a meaningful difference between buying into reasonable potential and buying into a speculative scenario, where you need results that dwarf the entire current output of the world's most profitable companies just to break even on the valuation. And then there is the circular nature of how this whole thing has been feeding itself, which is something I talked about in a previous video, and which I think is genuinely one of the more important things to understand about the market right now. Here is how the loop works. The biggest AI companies are spending enormous amounts of money on AI infrastructure. That spending creates revenue for other AI companies, which inflates their valuations. Those inflated valuations push their stock prices higher. Higher stock prices give them a larger share of the S&P 500. A larger share of the S&P 500 means more money from passive index investors flows into them automatically. That money pushes the stock price higher still, and the cycle repeats. The practical effect of this loop is that it makes the American economy look considerably stronger than it might otherwise appear. Deutsche Bank published data suggesting that if you stripped out AI-related spending entirely, the United States would already technically be in a recession. Think about that. The economic strength that gives investors confidence right now is, to a significant degree, being manufactured by companies spending money they have borrowed against a future that has not arrived yet. Sam Altman, the CEO of OpenAI, has committed to spending $1.4 trillion on AI infrastructure. His company currently generates between $13 and $20 billion in annual revenue. The gap between those two numbers is not a minor detail. It is a fundamental question about whether the economics of this build-out actually work. So what does any of this have to do with your index fund? It means that when you buy an S&P 500 index fund today, you are not just making a diversified bet on the American economy. You are making a very specific, very concentrated bet that the AI bubble, if it is a bubble, does not pop. And if it does pop, your supposedly safe, diversified, boring index fund is going to feel anything but safe. Now, one solution that comes up when people start worrying about this kind of concentration is the equal weight S&P 500 index fund. On the surface, it sounds perfect. Instead of 40% of your money going to 10 companies, each of the 500 companies gets roughly the same allocation, about 2% each. Every company is treated equally regardless of its size. You reduce the concentration dramatically. But there is a problem with the equal weight approach that most people overlook, and it comes down to something called negative momentum investing. This sounds complicated, but it really is not. Here's what it means in practice. When you use an equal weight fund and a stock starts rising sharply, the fund automatically sells some of that stock to bring it back down to its equal share. Think about Tesla during one of its massive runs. An equal weight fund would be selling Tesla as it surged and using that money to buy companies that had not risen. So you are effectively selling your winners and buying your underperformers to maintain the balance. Meanwhile, a standard market cap weighted fund does the opposite. It lets the winners run. When a company gains momentum, the fund allows it to take up a bigger share of the index. It reduces its exposure to smaller companies over time to make room for the growing giants. The result is that the market cap weighted fund captures more of the upside during bull runs in high momentum stocks. There's also the cost issue. The more a fund trades, the higher its costs. An equal weight fund has to rebalance constantly to maintain those equal allocations, which means more trading, which means more fees eating into your returns. It is a detail that gets glossed over, but can genuinely compound into a significant drag on performance over time. So if the standard S&P 500 has a concentration problem, and the equal weight version has a momentum and cost problem, where does that leave us? That is exactly what I have been working through. And it is why, for the first time in decades, I have been making meaningful changes to how my money is positioned. Let me tell you where I have been moving some of that money and why. The first shift I made was toward global diversification. And I want you to really think about this with me, because I know it sounds counterintuitive if you have spent the last decade watching American markets dominate everything. Imagine for a moment that the biggest stock market returns over the next 20 years do not come from the United States. I know that might sound outrageous. Over the last 14 years, American markets have been essentially untouchable. The S&P 500 has outperformed almost everything. Why would you look anywhere else? But here's the thing about markets. Leadership changes, dominance shifts, and no country stays on top forever. If you go back to 1900, Britain was the world's dominant economic power. London was the financial capital of the planet. British companies controlled global trade. If you were an investor in 1900, the idea that Britain would not be the top of the global stock market for the next 100 years would have seemed completely absurd. And yet, I remember seeing a very similar dynamic play out with Japan in the late 1980s and early 1990s. I was there. Japanese companies were performing extraordinarily well, particularly in automotive, electronics, and technology. The American economy at the time was struggling with inflation and slowing growth. A huge number of serious, thoughtful investors genuinely believed Japan was the future. If you had been investing back then, would you have bet against Japan and doubled down on America? Probably not. And yet, America came roaring back. The point is not that America is going to decline. The point is that the one certainty in markets is uncertainty. When you invest only in the S&P 500, you are completely missing companies like TSMC, Samsung, Toyota, Tencent, AstraZeneca, and HSBC. These are genuinely global businesses operating at enormous scale, driving real growth with real revenue, real earnings, and real competitive advantages. They are excluded from your portfolio for one and only one reason. Their headquarters happen to be outside the United States. That is why I've been moving a meaningful portion of my portfolio into a global market fund. The one I personally use gives me exposure to roughly 3,800 companies across more than 45 developed and emerging market countries, including the United States, the United Kingdom, Europe, Japan, and fast-growing economies like China and India. It has an expense ratio of less than 0.99%, which means for every $1,000 invested, you pay less than $2 a year in fees. Now, you might look inside that fund and notice that American companies still dominate it by weight, because American companies are still the largest by market cap globally. But here's the key difference and the reason this matters. The global fund rebalances automatically based on what is actually happening in the world. If America continues to lead, the fund reflects that, and you benefit. If China or India or Europe starts generating the biggest returns over the next 20 years, the fund adjusts, and you capture that too. You're not locked into a single bet. The second major shift I made was getting more exposure to small and mid-cap companies, particularly in the context of artificial intelligence. And this is where I think the most interesting opportunity exists right now, so I want to spend a bit of time on it. Think about the market as being divided into 4 zones. The first zone I call the crowded zone. These are the giant companies with enormous market caps. The NVIDIAs, the Teslas, the Metas. Everybody is already invested here, including all the passive investors who do not even realize they are making an active bet. These stocks are already priced to reflect enormous optimism about the future. The upside that remains is limited relative to the risk you're taking. The second zone is what I call the defensive zone. This is McDonald's, Walmart, Coca-Cola, companies that people rely on regardless of what is happening in the economy. Warren Buffett loves this zone. These businesses generate predictable earnings, stable demand, and consistent cash flows. They are not cheap, but they are reasonably valued. The third zone, which I actively avoid, is the speculative zone. Smaller companies with enormous hype, sky-high valuations. Peloton during its peak, Beyond Meat. Companies like this. They are driven by internet enthusiasm and market momentum, more than by any underlying business reality. For me, this is closer to gambling than investing. But then there is the fourth zone, the one I find genuinely compelling right now. I call it the neglected zone. These are small and mid-cap companies that are quietly building real businesses, using AI as a tool rather than AI as their identity. They are not in the headlines. They are not being swept up in passive investment flows. They are not priced for perfection. Here is the insight that drives my thinking on this. The companies in the crowded zone are all making essentially the same bet, that whoever spends the most money building the best AI model is going to capture all the rewards. OpenAI, Google, Microsoft, Anthropic. They are in a full-scale arms race, spending hundreds of billions of dollars on compute, on talent, on infrastructure. But what if that is not how this plays out? What I am seeing more and more among startups and small-cap companies is a very different approach. They are not trying to win the AI arms race. They are building products that let users choose between different AI models. Gemini, ChatGPT, Claude, whichever one makes sense for the task at hand. They are agnostic about which AI wins. They are just building the layer on top. And this matters because AI models are rapidly converging in capability. The gap between the best model and the second best model is shrinking every quarter. When something becomes genuinely commoditized, when any model can do the job almost as well as any other model, the competitive advantage stops belonging to the people who built it and starts belonging to the people who use it most cleverly. Think about petrol for a moment. If you have 2 petrol stations side by side, one charging $1.50 per liter and one charging $3 per liter for marginally better fuel, most people take the cheaper option because it gets them to the same destination. When the underlying technology becomes good enough and interchangeable, value migrates away from the infrastructure builders and toward the intelligent users of that infrastructure. Small and mid-cap companies do not need to win the AI arms race. They just need to apply AI to solve a real problem more efficiently than the legacy solution. That is a much more achievable bar. And the companies that figure it out are going to compound in ways that the crowded giants simply cannot, because there is only so much upside left when you are already the most valuable company on earth. I am personally invested in a few small and mid-cap funds, and I'm also actively looking at AI startups. If you have built something interesting in this space, the email is in the description. I'm not promising anything, but I am genuinely looking, and I have been doing this long enough to know the difference between a real business and a pitch deck. The third change I made was increasing my allocation to gold. And I want to be careful here because gold is a topic that attracts a lot of noise. From both directions, people who think it is the only safe asset and people who think it is a relic with no place in a modern portfolio. My view is more nuanced than either of those extremes. Here is what changed my thinking. In 2025, gold was reclassified as a Tier 1 asset under the Basel III international banking regulations. What this means practically is that gold can now be treated the same way as cash or U.S. Treasury bonds on a bank's balance sheet. Suggesting that figures should be closer to 30%, a 10 percentage point increase in demand from institutions that collectively manage trillions of dollars, while supply is essentially fixed because you cannot print more gold, is a meaningful fundamental shift in the economics of the asset. And it is not just regulatory changes driving this. Central banks around the world, particularly in China, have been buying gold at an accelerating pace. China's gold reserves grew steadily from 2009 onwards, but in the last couple of years, the buying has intensified dramatically. There's a broader geopolitical context here, the effort to build what some have called a gold corridor, where gold can be stored across multiple locations and used as a medium of trust in international trade, particularly among the BRICS nations. This represents a genuine structural shift in how global trade might be settled over the next decade. For the first time since 1996, gold has overtaken U.S. Treasury bonds as the largest foreign reserve asset held by central banks worldwide. That is not a minor footnote. That is a signal that the countries and institutions that manage the plumbing of the global financial system are quietly shifting their confidence in a direction that should, at minimum, make any thoughtful investor pay attention. Now, I want to be absolutely clear about what I am not saying. I'm not saying gold is going to the moon. I'm not saying the dollar is going to collapse. I'm not putting all my money into gold bars and waiting for the apocalypse. I am saying that the structural demand for gold has increased in a measurable and fundamental way, and that having a strategic allocation to it as part of a diversified portfolio makes more sense now than it did 5 years ago. Personally, I buy physical gold as a long-term insurance policy. I also use a dollar-cost averaging approach to build a position in a physically backed gold ETF through my brokerage account, which gives me much more flexibility to add to my position gradually without trying to time the market. I am not trying to catch the perfect entry point. I'm simply ensuring that a sensible portion of my portfolio benefits if the things that are currently making me nervous actually materialize. The fourth change I made was increasing my cash reserves. And I know that sounds boring. Cash earns less than inflation over the long run. Everyone knows this. But there is a function of cash that goes beyond its return as an asset, and that function is optionality. Warren Buffett, the most successful investor alive, has been aggressively building his cash position for the last 2 years. As of the first quarter of 2025, Berkshire Hathaway was sitting on $347.7 billion in cash. For a man whose entire career has been built on the principle of putting money to work, that level of cash hoarding is a statement. He is a value investor. He only buys when the price makes sense. The reason cash matters during a correction is simple. When markets fall, the people who have cash can buy. The people who are fully invested have to watch. And often the people who are fully invested in falling assets are under psychological and sometimes financial pressure to sell at exactly the wrong moment, locking in their losses and removing themselves from the eventual recovery. I have watched this happen too many times over my career. Someone builds a solid investment portfolio over years. The market drops 40%. They panic. They sell. They swear off investing forever. The market recovers. They miss everything. They eventually come back near the top of the next cycle, and the whole tragedy repeats. Having a cash cushion prevents that. It keeps you financially stable enough that you do not have to sell in the worst conditions, and it gives you the capacity to buy when everyone else is selling, which is historically the single best moment to enter the market. When the market corrects, and I say when rather than if, because this is simply what markets do, I want to be in a position to buy aggressively, not a position where I am scrambling to cover my expenses or holding on to assets I should be adding to. The fifth shift I made is perhaps the most personal, and it is about income. During the dot-com crash in the early 2000s, one of the things that gave me genuine financial resilience was my ability to generate income outside of my investments. When your investment portfolio is down, having other sources of cash coming in is not just psychologically comforting, it is practically powerful. It means you do not need to draw down your portfolio to live. It means you can stay in the market. It means you can actually buy more of what the market is selling off. I have spent a lot of my career developing skills and systems that generate income independently of whether the stock market is going up or down. And if you are serious about building wealth over the long term, I would argue that this is just as important as any investment decision you make. Because the real compounding power comes not just from the returns on your existing capital, but from your ability to add capital consistently over time, especially during the periods when most people are too scared to. So let me bring all of this together because I want to be clear about what my actual strategy looks like now. The majority of my portfolio is still in the stock market. I have not abandoned equities. I have not gone to cash entirely. I have not made some dramatic call that the market is going to crash and structured my entire financial life around being right about that. I might be wrong. The AI build-out might deliver everything the optimists are promising, and in that case, having exposure to the S&P 500 means I participate in that upside. I'm not trying to be heroic. I'm not trying to be the person who called the top. That is not investing, that is performance. What I have done is build a portfolio that works reasonably well in multiple scenarios rather than being perfectly optimized for one. I still have a significant allocation to US equities through the S&P 500 because if the bull case plays out, I want to benefit from it. I have diversified a meaningful portion into global markets because I do not want my entire financial future to depend on American exceptionalism continuing indefinitely. I have exposure to small and mid-cap companies and AI-adjacent startups because I think that is where the most underappreciated opportunity sits. I have a strategic allocation to gold because the structural demand for it has shifted in ways that are not fully reflected in how most retail investors think about it. And I am holding more cash than I historically have because optionality has enormous value when markets are at elevated valuations, and the dominant narrative is built on optimism that has not yet been validated by actual revenue. None of this is revolutionary. None of this requires you to be a genius or to have access to information that ordinary investors do not have. It requires you to look honestly at what you actually own, what risks you're actually taking, and whether those risks are ones you consciously chose, or ones that crept into your portfolio through the mechanics of passive investing without you ever making a deliberate decision. That, more than anything else, is what artificial intelligence forced me to confront. Not because AI is definitely a bubble, not because these companies are definitely going to collapse, but because the scale of optimism baked into current valuations, and the concentration of that optimism inside an instrument that most people use, precisely because they want to be diversified, is something that deserves serious and honest attention. The best investors I have known over 35 years of doing this are not the ones who made the biggest concentrated bets. They are the ones who survived the downturns, who kept their money working through the full cycle, who had enough stability and enough cash that they could act instead of react when everyone around them was panicking, and who were humble enough to recognize that certainty in markets is an illusion, that the best you can ever do is stack the odds in your favor across multiple possible futures. That is what I am trying to do. And I hope watching this has given you at least a framework for thinking about what you might want to do too. If you have been investing passively for years and never looked closely at what your index fund actually holds right now, do that today. Pull it up. Look at the top 10 holdings. Look at what percentage of your money is in those 10 names. Think about whether the bets embedded in those holdings are bets you would consciously choose to make, and then make whatever adjustments align with your own situation, your own risk tolerance, and your own honest assessment of where we are in this cycle. The people who build real wealth are rarely the ones who followed the crowd perfectly. They are the ones who understood what the crowd was doing, thought carefully about whether it made sense, and had the courage to position themselves differently when the evidence called for it. I have tried to do that throughout my career, and I will keep doing it, especially when the conventional wisdom says there is nothing to worry about. Take care of your financial future. Think independently. Stay curious, and I will see you in the next one.